I am Sopia with Global Pulse. Let me talk to you today about what's really happening beneath the surface of these massive moves we're seeing in gold and silver, because a lot of people are looking at the price action and asking the wrong question. The conversation out there keeps circling around whether this is the top, whether this is some kind of blow-off phase, whether we're watching a classic bubble form. But when I step back and look at the structure behind the move, what stands out to me is something far more serious than speculative excitement. This doesn't look like mania. It looks like pressure building inside a monetary system that's been stretched beyond its limits for decades. Gold holding above the 5,000 level isn't just another milestone for traders to celebrate. Silver stabilizing after dramatic volatility isn't simply a story about momentum cooling off. What I'm seeing is a reflection of deep instability in the currency framework that underpins the global economy. Prices aren't screaming irrational exuberance. They're whispering something far more unsettling, a slow erosion of confidence in paper money itself. When metals move like this while risk assets elsewhere struggle to keep up in real terms, it sends a signal, not about speculative frenzy, but about protection. Historically, whenever societies leaned too heavily on debt and promises instead of tangible value, the adjustment didn't arrive all at once. It came gradually, and then suddenly. That transition often began quietly, masked as a strong bull market in hard assets before revealing itself as a deeper shift in trust. And trust is really the center of this story. For decades, economic growth has leaned on expanding credit rather than expanding productivity. Governments spent beyond their means, central banks filled the gaps, and the assumption was always that more liquidity could solve any imbalance. But when money creation becomes the primary tool for managing structural problems, the long-term cost isn't immediate inflation alone. Its credibility. What we're witnessing now feels less like a speculative rush into metals and more like a cautious drift away from financial promises. Even when prices correct sharply, the underlying narrative doesn't disappear. Silver's pullback from extreme highs hasn't erased the broader context. Gold maintaining strength despite volatility elsewhere reinforces the idea that these movements are not driven by hype cycles alone. Instead, they're tied to something systemic, the growing realization that debt-based systems eventually face limits that policy tools alone cannot overcome. Right now, the gold-to-silver ratio still sits far above historical norms, suggesting silver remains undervalued relative to gold in structural terms. Depending on how you measure physical supply versus paper claims, the imbalance becomes even more pronounced. In practical terms, that gap points to either a future repricing or a prolonged distortion that markets eventually resolve. Meanwhile, positioning data shows something fascinating. Institutional momentum hasn't fully embraced this move. In fact, in some cases, speculative positioning has thinned out rather than intensified. That's not what you expect at the peak of a bubble. Typically, bubbles are fueled by widespread participation and enthusiasm. Here, we're seeing strength in price without a matching surge in speculative conviction. That divergence matters. It suggests the move is being driven by structural demand rather than emotional chasing. Physical demand remains resilient despite price swings, and supply constraints are not easily solved by higher prices alone. A large portion of silver production comes as a byproduct of other mining activities, meaning supply doesn't instantly ramp up just because prices rise. At the same time, silver's role in emerging technologies and defense applications continues to expand, making it strategically important in ways that go beyond traditional investment demand. When something transitions from being merely valuable to being necessary, its pricing dynamics change. Gold, on the other hand, is increasingly being treated less like a trade and more like a form of financial insurance. Central banks accumulating reserves send a clear signal about long-term thinking. They're not chasing quarterly gains, they're preparing for resilience in an uncertain monetary environment. And here's what stands out to me most: broad retail participation still appears limited. That absence tells us something powerful. Major tops are usually marked by widespread excitement and overexposure. What we're seeing instead is a quiet repositioning among institutions and sovereign actors, while everyday investors remain hesitant or disengaged. This doesn't resemble a crowd rushing into the trade. It resembles a cautious shift by those focused on preserving purchasing power rather than maximizing short-term returns. Of course, none of this eliminates the possibility of volatility. Parabolic moves often retrace. Sharp corrections can and do occur. Markets rarely move in straight lines, but short-term pullbacks don't necessarily invalidate the long-term direction when the underlying driver is structural rather than emotional. The real tension lies in the choices policymakers face. Protecting debt markets often requires maintaining liquidity, but doing so can weaken currency strength over time. Defending currency value through tighter conditions can strain economic growth and trade competitiveness. In a system built heavily on leverage, letting debt markets falter carries consequences that ripple far beyond finance. So the path of least resistance often becomes gradual currency erosion rather than abrupt systemic shock. That erosion doesn't announce itself loudly. It unfolds quietly, through purchasing power slipping year after year until the cumulative effect becomes undeniable. From that perspective, rising metals aren't the cause of instability. They're the symptom. They reflect the slow recognition that storing value in tangible assets may offer a steadier foundation than relying solely on financial abstractions. And that recognition doesn't happen all at once. It builds through observation, through experience, through cycles of volatility that gradually reshape expectations. We're not seeing universal enthusiasm yet. We're seeing selective preparation. Some participants are focused on staying wealthy rather than becoming wealthy. That mindset shifts the role of metals from speculative vehicles to strategic reserves. Instead of chasing price appreciation, the goal becomes maintaining purchasing power across uncertain environments. That distinction changes behavior. It also changes timing. Because when protection, not profit, becomes the primary objective, decisions tend to be made earlier, before consensus forms. None of this guarantees a straight path upward. Markets can remain distorted longer than expected. Paper mechanisms can influence price discovery for extended periods, but physical supply and demand eventually assert themselves over time. The deeper issue isn't whether gold or silver are expensive today. It's whether the units used to measure them are becoming less reliable. And when that question enters the conversation, the entire framework shifts. This isn't about predicting exact price targets. It's about understanding why these moves are happening in the first place. If this were purely speculative, we would expect to see widespread excitement, heavy retail inflows, and euphoric narratives dominating the landscape. Instead, what we're observing is a steady repositioning beneath the surface while skepticism remains widespread. That combination rarely marks the end of a move. More often, it signals the early stages of a broader transition. So when you look at gold above 5,000 and silver navigating its volatility, it may be more accurate to interpret those levels not as warnings of excess, but as reflections of changing trust dynamics. Trust, once lost incrementally, tends to accelerate in its decline. And when confidence in financial promises weakens, tangible value often regains prominence. That's the deeper story unfolding here. Not a rush into metals, but a gradual step away from assumptions that once felt unshakable. And that's why this moment deserves attention, not as a spectacle of price, but as a signal of shifting foundations.